Hey there, traders. How are we all? So I absolutely suck at trying to create shorter videos. This is my third attempt. Um, so let me get straight to the point. So firstly, I'm hoping that you and your family are all well and safe from the big bad coronavirus. And there's a very good chance that all of you are in some form of a curfew or a lockdown right now. So, right now probably is the best time to address any major issues that you have with your trading game. And the two biggies are fear and impatience, right? I can tell you without a shadow of a doubt that after, what's that, 16, 17 years worth of trading, um, fear will not leave you. Um, and impatience is never really going to go away. But like everything else, you can mitigate all forms of risks that exist. And so, how I handle it is this: one, you've got to maintain a demo account always. Not every single trade you take has to be in a live account, right? That's the first thing. And throughout your life, you are going to constantly be testing your methodologies, constantly, because market conditions will evolve, right? Your criteria probably won't ever change. Your setup, like what we're trading, which is price action primarily, it's never going to change. But the application may, for example, right now, with all of the volatility, what you're probably finding is that where a currency pair or a commodity used to run for 80 pips or 100 pips in a day, um, right now it's running to 300 pips at a time or maybe more. Like with gold, the ADR for gold right now is at 626 pips. So that is massive. When we're looking at a setup like this, for example, and we wanted to short the market here, if we were to look at, say, coming back to my EMA 18, price all the way to where my safest stop loss would be is at the EMA 200. That's 57 pips. And so what you do really have to do is question whether that fits into your trading plan, right? That so there's a lot of stuff that's happening then, and that's when um, the criteria may morph slightly or something along those lines. So for you to be then testing um, all of these changes that you're bringing to your criteria, you do need a demo account for that. Okay. Now, when it comes to our criteria and our setup, we're all quite familiar with it. I don't think this is very hard because there's only a handful of things that you're going to be trading anyway, right? I don't care if anyone's out there telling you, or you're telling yourself that there's so many things in the trading game that you need to know, then you're fooling yourself. And if someone else is telling you, tell them to piss off because none of that's true. There's only a handful of things that you're going to be trading um, or need to know in regards to trading. When it comes to structure, there is really only one recognizable structure that everyone trades. It's just different courses and programs. They just rename them because, hey, if they told you it's all just Elliott wave structure, would you pay 5K to learn that shit? Or would you just say, hey, I could just learn that off the internet somewhere? Maybe just come to Shiva's channel and learn it for free. But here's the thing. Elliott wave structure, right? It's just a five-wave movement. Forget about the technicalities of that. If you see a massive double bottom formation here over a few sessions, markets moving, the EMA 50 and the 200 cross, and then you're seeing somewhat of a corrective pattern forming, and that could be a channel, a wedge, or a triangle, well, hey, that for you should be a light bulb going off saying, hey, this is probably a second wave or fourth wave structure forming within the Elliott wave structure. That's all you've got to do. If you see that and you recognize it, the next thing is, okay, let me just grab my fibs. Let's see if price is coming back to 618 or 382 or 50. And if it is, and that just so happens to be where our EMA 50 is after the cross of the 50 and the 200, then what we're looking for is a candlestick pattern at our London Open or New York Open. That's all we've got to do. And after that, so if the market's going up, you're looking for a morning star pattern, an engulfing candle, or a tweezer bottom. That's it. If you see that, there's a very good chance that you could take a trade on the open of the next candle or the pullback of the next candle, and there's probably a 90% plus chance you're going to make some money. Right? That's all it is. All you've got to do now is to break that down further and say, be a picky prick and say, okay, I like my morning star patterns, I don't like my evening star patterns. I like a engulfing candle, I don't like tweezer tops and bottoms or whatever it may be. So pick one, two, three um, of the candlestick patterns that you like. Pick between your channels or your wedges. Um, you might say, hey, I only like trading the beginning of the third wave. Well, make that your thing, right? Or I only like in my case, by far my favorite trades, which do get the bulk of the lots on thrown onto them, is when I'm shorting the market. It's when I am going long, it's just my results. When I look at it, I put less lots on going long and more lots when I'm shorting the market. It's just me. And so when you know yourself, that's probably what you do as well. So do that, write it down, know yourself, pick your criteria, and know this handful of trade setups that you do. And then the next step is, if you are a new trader or still somewhat of a existing trader over the last few years that hasn't been doing very well, take those setups right now onto your demo account and just trade them. Every time you see the setup, practice, trade. Take a trade on the open of the next candle and take another trade on the pullback of that next candle, right? And then write all of this information down. Become a data analyst. Collect this data. Now, when it comes to that, a lot of people think, okay, when I'm trading on a demo account, I tend to be more cocky. And when I'm on a live account, I'm kind of more fearful. So I'm not taking the right trades. That's what people think and say to me all the time. But here's the thing. Your focus has to be less on money and less on winning and more on playing this technical game. Is where I see this setup and I want to take this trade and I just want to make sure that I take it at the open or the pullback. And that's when you can experiment with different EMAs and stuff and say, if it's on a pullback, here's where I want price to get to, and then go do 10 trades, 20 trades, 25 trades, whatever number of trades that you want to take that's going to give you to some extent a statistic that you can work with, right? If it's 8 out of 10 trades work for you there, you got an 80% win rate. If it's I don't know, you did 50 trades and you got 40 right, you made 20 pips or 25 or 30 pips on 40 of them, then that there is an 80% win rate, something along those lines. Then what you want to do is take those losing trades and then analyze them. Chances are every single one of those losing trades did get to 10, 15, 20 pips and you made some money out of it before it reversed back against you, right? So analyze them and say, what am I seeing here? Chances are there's going to be a time when a broker's messing with you or you forgot to look to see if there's news. And there are going to be times when there's no news and the market's just, one candle has gone and created a wick for 80 pips, 100 pips or something. At this time, it's very likely. So you're screwed there. But certainly analyze that, write that down and say, yeah, this is something that's out of my control. So, but there might be other losing trades where you figured it out and you say, yep, when I see this behavior, for example, there was a trade, was it Euro AUD? Yeah, I think it was Euro AUD. And this is what I mean, like where this massive drop happens, chances are we probably don't know why it happened. Okay, it was here. So this was a trade that I had taken, and where this was an engulfing candle. Mind you, I was a bit of an idiot where I didn't look at how many hits to the EMA 50 happened earlier. And this is what I mean. There's going to be so many times you're just going to do cocky trades. It's very important that you have some sort of like a recovery in your mind. So I waited for this pullback. I didn't. My EMA 18 isn't down above here. Usually it's what I use to take an entry on a pullback. So and when EMA 18 is usually down here somewhere, I ignore those trades. But like I said again, I was a bit cocky here. I waited. Price hit my EMA 50, and I shorted the market there. Right. I was very happy at this point in time, 20 pips in the money, and here 30 something pips in the money. And here's what happened though. The market created somewhat of a tweezer bottom of my EMA 18 and then pushed all the way up till this point here, right? This is where a little bit of experience or spending time in front of your computer, staring at the charts is going to help you. You'll start to see certain behaviors. Now, when I saw this happen here, I jumped out of the market straight away, right? If I would have let that go, that probably would have pushed up to stop me out. Um, but 14 pips wasn't really that bad, right? You need to be mindful of changes that happen um, within life price. Um, and so you need to be able to say, yes, I'm going to make decisions as to what am I going to do in real time. Now, here, in this case, yes, because of my choice of entry, I was able to um, get out of that trade and still make money, right? Whereas in this case, like if you were to look at the size of this candle, say from the close till where it opened is 38 pips. Remember when I'm talking about within my charts or within my videos is when I'm measuring wherever that pullback could go to, where that beyond that EMA where my stop loss is going to be. If it's too big, it's a trade I don't want to take, right? But in this case, I took it at the EMA 50, and so my stop loss really wasn't that big, okay? Because again, it's just, I can't remember where I put the stop loss. I think it was above here somewhere. It was about 20, 25 pips. But the thing is that it gives me room to maneuver now. Now, if I would have taken my trade at the open of this, completely ignoring the fact that this is a 38, 39 pip candle, chances are by the time this happens, I'm out of the money. And so I'm going to lose a little bit of money. Now, with a micro lot or mini lot, it's not going to matter. But when you're at um, full standard lots or multiple standard lots, yeah, it is going to matter. Okay, so be mindful of that sort of stuff. And this is where I want you to take those losing trades because there's a very good chance that some of you might have traded this and then would have been stopped out. So go analyze this and say, for how long would I have been in the money? Is there something that the market is doing that is telling me that probably I need to probably get out of that trade and secure whatever profits I've already made, right? So analyze all of that. And the more you do that, the more you're going to mitigate any of the fears that you have, right? The next thing is with impatience, it's the same rules to what I've just spoken about in regards to fear. Have a separate demo account. If you're impatient, take that damn trader on that demo account and walk away. What I do is if I've got that itch I need to scratch and I'm looking at the charts and there's nothing really there for me to trade, I probably just take a trade on that demo account, close that account, walk away. I don't even care whether that made any money or it didn't make any money. I'd rather not know because chances are that probably would have lost money. I don't want that to be a part of my subconscious trading game. And so I'll just do that and then I'll go do something else for that time period. Okay? So, again, first thing is get to know your criteria and understand there's only a handful of trades that you will, or setups that you will be taking trades on. Understand what they are. Get to know your morning star, evening star, engulfing and tweezer top and bottom pattern well. That's got to fall in line with the structure, the trend, the corrective wave, and also the London Open and New York Open timeframes. Check to see if there is any news that could disrupt that, right? And then certainly take that trade and then watch it like a hawk up until that point wherever you think this market's going to go till, or up until a point you've captured a set number of pips. Take screenshots of that, write that details down somewhere, and then later on analyze that because you really want to know why that worked or why that didn't work. Once you have that, fear's gone. Same deal with the impatience because you'll just be able to recognize, yeah, this doesn't work right now. I'm going to go do something else. The other thing that I want you guys to do is start off again with a handful of currency pairs or commodities that you're trading. I want you to do regular or daily top-down analysis, and that basically means right now is where you're looking at some sort of structure on a 15-minute chart or a 1-hour chart and you think, hey, this is beautiful. You want to verify with your daily chart to say, yes, my daily chart is moving in a specific direction or in line with whatever I'm predicting. And for that reason, this becomes a safer trade. You're just mitigating those risks because the more you know, the less fear that you will have, right? And then go from daily to hourly to 15-minute chart. Look for the same story being told. If that's the story that you see, then that just adds another degree or another layer of confirmation for you to be able to take that trade. Demo it, get your statistics right. So if it's 8 out of 10 trades, your 80% win rate. If it's 40 out of 50 on demo, that's still an 80% win rate. So do something along those lines. Become data analysts, collect data and analyze your wins and losses, and certainly that will mitigate whatever fears that you still have, right? Beyond all of this, another area I really want to touch upon is this. So a lot of people have over the years asked about stop losses, right? Here's another way of looking at stop losses. Stop loss has got to be a safe area where you feel that price is not going to go beyond or come close to, right? Now, when we're talking about coming close to, we're also talking about where, if say for instance here, this is what's this? This is gold, right? For this red candle here, price went up to that point, right? Now let me calculate from there to where the EMA 200 is. Now, the spreads on gold right now is crazy, right? I had taken a trade last week where gold was at, see right now it's about six pips. I had taken a trade last week where gold was at 29 pips spread on the Think Forex platform. The DMA was much better, but here was 29 pips, and I had taken a trade on that. So be mindful of that. Now, what happens here is, say for instance, I would have taken a trade to short the market at 29 pip spread, and price came up here, but my stop loss was up here somewhere, right? So at 28. Let me just drop a line there, and say for instance, I thought, hey, it's a safe place above my EMA 200, and my stop loss was there. If that spread was at 29 pips at that point in time, I would have been stopped out of that trade, right? Be mindful of that in times like this with increased volatility, that at any given time, a broker could go absolutely nuts with their spreads, depending on currency pair and commodity, of course. But be mindful of that. Now, when I'm looking at spreads and stop losses, it's got to be a point where price is not going to get to, and price plus spreads it's not going to get to. And if I am careful with my selection and successful with my selection, then price could do whatever it wants in the middle of that. So say for instance, I wanted to forget the EMA 50 being here, and I say this is bouncing off a critical area, it's a double top formation, I'm going to take a trade on the pullback. And by the way, when I said I use my EMA 18 here for pullbacks, basically there's another EMA, this green one, which is the 30. That's not what I'm using, okay? It's a different thing entirely. That's a different strategy entirely. I use that primarily with equities. However, with this yellow line for me is my EMA 18. And whenever price pulls back to that point is where I usually think it's a safe pullback for me to take a trade, right? So say for instance I want to take a trade there. I want to look to see where the safest place for me to place my stop loss is. Right now that's 50 something pips at my EMA 200, the closest EMA, right? On a downtrend, I'm looking for an EMA at the top. So I've got to then be mindful of whether price could kind of bounce off back to that point, and if price could, with increased spreads, hit that area. And it's got to be a point where I know or feel that price cannot or will not go beyond, including spread. That's where price has to be. You've got to lock that in, and that's got to be where it doesn't matter what price does down here, you're going to stick by that, right? And then let price do its own thing. So right now, it's very important that this area here, where you're focusing on that point where your stop loss has to be, which price will not go beyond, that's what it's something that you got to really figure out right now. because with increased volatility means that price is going to fluctuate a hell of a lot more. And for many of you, if you're still maintaining those really tight stop losses, you're going to get stopped out more than you're going to make any money. So be mindful of that. Please don't put a stop loss in for 50 pips or 40 pips or even 30 pips whilst you're only aiming to take profit at 15 or 20 pips or 25 pips. Your stop loss cannot be bigger than how much in pips and profits that you're trying to lock in, right? Why? Because there's always going to be the off chance that the market does go against you briefly before it comes back in. And if your broker increases spreads, you're going to get stopped out losing 30, 40 pips where your target price was probably only about 20 pips away. So common sense applies. All right. Please go do the things that I've mentioned in these videos. Go do 20, 30 demo trades and continue doing regular demo trades because over time you're going to be constantly readjusting your approach to trading. You'll be doing exactly the same criteria, exactly the same setups. The structures will be the same. The corrective waves will be the same. The candlestick patterns will be the same. But just increased volatility might mean that your stop losses are starting to become bigger. So you will have to adjust. And in your adjustments, you are going to demo those changes, right? You're not going to go live straight away with some sort of a changed approach to your trades, all right? So demo that. Please maintain the demo account and constantly retest yourself, okay? And then play around with the stop loss concept to see where that is safe. Because I can tell you this just before I finish off. Whatever trades I've lost in the last 17 years of trading, a huge chunk of that wasn't that my prediction or the trend direction that I had predicted was incorrect. It wasn't that setup that I thought would have made money was incorrect. They were all correct. It was more so that I probably didn't select the right stop loss. So the market came back, stopped me out before it went and did whatever it did, right? So that's the reason why knowing that point where price is not going to reach, very, very important. For many of you, the issues you will have with your broker most likely will have to do with spreads. But when it comes to DMAs are not, which is direct market access, is not readily available to retail traders. Some of the stuff that's out there right now is crap. They're not regulated, so it's probably not the way to go anyway. But with all of the ECN brokers, liquidity is going to be a massive problem. And so we will have to go with brokers like Think Forex, which does both market maker operations and ECN. So that's an increased risk that we do take. But be mindful of the fact that with that now also comes the increased spreads. And so counter that into wherever your stop losses go. And if you do check your stop losses, the spreads before you take an entry and it's a massive spread, please don't take that trade. I sometimes miss it myself. Like I said, I did a trade last week which was 29 pip spread. So just be mindful of these things and you won't go wrong. I think that's about it. I don't think there's anything else there. Please stay safe. If any of you need to boost your immune systems, that Spirituality Zone site, channel that I've put up, there's a coronavirus boost immune system file that's on there. So listen to that, just play that in the background, and it will help boost your immune system and counter coronavirus. There's shields built into that as well, energy shields, so that when you're out and about, if someone with the virus actually crosses you, the shield will to a large extent protect you. It's an energy thing. All right, so all the best, guys. Stay safe, be well.